tax planning. It's one of those things that we just don't like to do. In other words, we do anything other than tax planning if we could. We'd go to the dentist if we could before doing any tax planning. Hi, my name is Alan Mercurio. I wanted to get back with you guys and kind of give you some information about a tax tip that a lot of people don't talk about, a lot of people don't know about, but could actually save you a lot of money on your 401k withdrawals and your distributions from your retirement account. Many people don't know about it, but if you work for a publicly traded company, somebody that's a company that's on the New York Stock Exchange or on the exchange in itself, a publicly traded company, a lot of times you can actually invest in your 401k or in the company stock that you work for inside your 401k. So you might be able to buy, if you work for UPS or you work for Yum Brands or you work for Ford Motor Company, AT&T, you might be able to buy that stock in the 401k. And a lot of times you can buy that stock at a discount. So you might even be able to buy it at 10 or 15% below the market or the street price on that. So it's usually a pretty good deal to buy it there. And if you're working inside a company, a lot of times you're going to have inside knowledge about how that company's working, what kind of deals are going on, what kind of business flow they have coming in. So you feel a little bit more comfortable buying at least part of your 401k investment inside that company stock. But the problem exists that when you start to leave the company or when you get ready to retire, you still have all that company stock. So we always recommend that you keep that number to a smaller percentage of your portfolio, especially as you get ready to retire. Maybe you pull that back to no more than 20% of your total investments in your 401k plan. Again, just for diversification purposes, because I've seen over the years I've been doing this, I've seen folks that have had everything that they invested in their 401k invested in the company stock, and that company stock have troubles right as they're getting ready to retire, and virtually the client or the prospective client could lose everything or a big portion of their 401k because the stock turned against them at that particular time. So by keeping a smaller amount inside that 401k plan, you're going to limit that risk that you could have going forward on that stock. But then again, how do you reduce the tax when you take stuff out? So typically when you take money out of a 401k, an IRA, or any of those tax deferred plans, you're going to pay regular income tax on it. Meaning that if you're in a 22% tax bracket, you're going to pay your full 22% tax on that withdrawal, and it's just added to your income at the end of the year. It just shows up as part of your wages for that year. Even though you're not working, it shows up as part of your earnings, and you have to pay full tax on it. But what if you could take some of that and only pay capital gains tax on it, capital gains tax rates? Now, if you don't know, capital gains tax rates there's short-term capital gains and there's long-term capital gains. Short-term is anything owned for less than a year. Long-term is anything owned for more than a year. So if you've owned your stock inside your plan for more than a year, then it qualifies for a better long-term capital gains tax rate. Currently, the three tax brackets for long-term capital gains is 0, or 10%, or 20%. Okay? So if you're, depending on your level of income, how much money you're claiming that year, it's going to dictate what level you fall into on that capital gains bracket. But this is a rule that came out several years ago. A lot of advisors don't talk about it. We try to remind people about it every chance we get, just to make sure that you're using it if it works for you. It's called Net Unrealized Appreciation. So what the IRS will allow us to do is that if you have a position of stock inside your 401k plan, and this is a part of your company stock, let's say I'm going to use the example of Ford Motor Company. So let's say you were able to buy Ford Motor Company stock inside your plan. As an employee for them for the last 30 years, you purchased that stock as part of your retirement plan. Now you're coming up on retirement. You've got, let's say you've got $200,000 worth of Ford Motor Company stock inside your 401k plan. But you've only invested maybe $50,000 of your actual money in that stock. So it's grown from $50,000 to $200,000. So you got $150,000 gain in that stock. Well, typically the rule would be is that as you get ready to retire, you just pick up that whole 401k and you move it over to an IRA account that you're going to either have managed or you're going to manage it yourself, and then you're going to withdraw money out of that account as you need it, or set up some kind of income strategy to pull income out of that account to fund your lifestyle in retirement. And that's great. That's perfect. That's how you want to do it. But here's the thing, is that if you do it that way, if you pull it all out and move it over to the IRA, then now all of that money that's in the IRA is going to be taxable at whatever income tax bracket that you're at as you start pulling it out. Well, some of you, if you work for Ford, you're also going to have a pension, or most of you are going to have a pension, and you're going to have Social Security. So two sources of income coming in there. So let's say that adds up to $40,000 or $50,000 a year in retirement, and now you take some money out of your 401k, then you're going to be fully taxed on that, so that may jump you into another tax bracket. Okay, so the technique, the net unrealized appreciation, allows you to take the block of stock and move it outside of the 401k into an after-tax account and only pay tax on the investment part. So let's go back to the example for a second. Again, remember, you've invested $50,000 in the Ford Motor Company stock as part of your retirement plan. It's grown to $200,000 inside your 401k plan. And let's say you got another $200,000 in there. So now your total 401k is $400,000. So the way you would do this is you take the $200,000 that's not the stock, and you just roll it over to the IRA like I talked about before. So you just pick it up and move it over, and then you can invest it. And you will pay regular income tax as you draw that out. The stock, though, you take it out and you roll it into an after-tax account called a brokerage account. Using this net unrealized appreciation technique, you're able to capture that $50,000 that you paid or you invested in the stock. Okay, so you pay tax on that now. It's your current tax bracket. So, whatever your tax bracket is, you got to pay tax on that $50,000. But the gain, the $150,000 gain that you made on that stock over all the years that you worked, you don't pay any tax on that until you sell it. And when you sell it, you only pay your capital gains tax rate on it. So again, if you're following what I'm saying, you can create a lower tax by setting that capital gains money or that gains on your investment aside inside your plan and move it outside and capture that lower tax bracket, pay regular income tax on the income that you pull out of the IRA, but now you're only going to pay tax when you sell this stock, and you're only going to pay capital gains tax rates under the net unrealized appreciation. Great way to build a plan, great way to have lower taxes in your retirement plan. Not too many people are using this technique. If you are one of the folks that have had company stock inside your plan and you've been able to invest in that company stock over the years, it's a great way to reduce your taxes. And we have to take advantage of any opportunities that we have to reduce our taxes in retirement. That old myth about taxes are going to be lower in retirement, I think it's just a myth. We have to get ready for taxes being higher in retirement for a number of different reasons. I mean, number one, I think that everybody's going to continue to want to live a decent lifestyle in retirement, which takes income. Income causes taxes, so you want to make sure that you're paying the lowest taxes that you can. Doing that tax planning can help you do that. Hopefully you've enjoyed this video. If it works out for you, that this is something that you can use, I hope you can use it and benefit yourself out of it. If you need some help, contact us at louisville'sretirementcoach.com. We're always available to counsel you through how to do that, or to come talk you through the strategy behind it, or your advisor can contact us as well. If you like the video, hit the thumbs up button. We really appreciate you doing that. And if you want to subscribe, you can hit the subscribe button, and also hit that little bell over there, and you'll be alerted anytime that we have any kind of new content come out here. So with that, hope you all have a great day, and look forward to talking to you and seeing you soon. Thanks.